Finance can be messy, but don't worry, we clean it up with facts, fun, and maybe a little sarcasm. Welcome to the Financial Sandbox. Let's get into it. Today, my guest is Erica Blue from Trilogy Real Estate. How's it going?
It's going
What are you
good,
doing?
Herb. How are you on this beautiful Friday?
It's great. As you know, I'm here in San Francisco where the rain has stopped, but we're still going to get some more rain down the road. And you're down in Santa Barbara, right? Or Bakersfield.
I
Bakersfield.
wish. I would, yeah. I'm in Bakersfield, so just inland from Santa Barbara. Shouldn't say just inland, a few hours.
Nice. Hey,
Yeah.
Erica, tell us a little about yourself and your role at Trilogy, and then we're going to do a little brief intro on who Trilogy is and how you guys got into this space.
Yeah, great. Like you mentioned, my name is Erica Blue, and I'm a regional VP for Trilogy Real Estate Group. I grew up in Orange County, California, where obviously real estate is king. And I think that probably fueled some of my ideas to wanting to get into commercial real estate investments. But other than that, grew up doing a lot of swimming, a lot of water polo. And now I live in beautiful, beautiful Bakersfield, Kern County, California, the epicenter of all the agriculture of the world. And I
That's right.
reside here with my husband and two daughters.
Awesome. Awesome. So
Yeah.
you are you're a remote rep. We've dealt with in the past couple of years so much stuff with COVID where people are working at home,
Mhm.
but you've always sort of worked at home, right? And this isn't a surprise to you.
This is not a surprise. COVID obviously brought a lot of changes for most, but for me, I've worked from home since I was before I was pregnant with my oldest, who's now turning 14. So I've had the opportunity to be an internal wholesaler, which is inside sales, if you will, representing different regions of the nation and different kinds of tax advantage real estate strategies for the better part of now 14 years.
Awesome. So Trilogy, tell me a little about Trilogy, and first of all, why did you join Trilogy, and what's their secret sauce?
Yeah, perfect. I joined Trilogy probably, I would say, primarily because of their track record. So, launched in 2002 across three different real estate downturns and can very proudly state no investor losses through those three real estate downturns, which I've never been able to say at another firm in my 15 years or so history. So that was a huge bonus for me. I really believe in the multifamily story. I recently completed my master's in real estate through Georgetown with an emphasis on development. So I've done more research and more studied and written more papers on the multifamily story and the current housing crisis than most. And
Right.
so getting to couple those, working for a firm that I believe in with a sector of real estate that I really believe in and value, and hopefully getting to bring some units to the national housing crisis of 4 to 7 million, somewhere in between there. Either way, it's a lot. Either way, it's too many that we need to account for.
So Trilogy isn't one of these companies that does 12 different things. You guys really stay in your lane. What is that lane?
That lane is multifamily apartments.
That's
Completely.
it.
Just
That's all you
multifamily
do.
apartments. That is it. That is our bread and butter. That is the lane that we like to stay. We have a pretty large scale. So we have 2.6 billion in portfolio value and have conducted 4.5 billion in real estate transactions. So again, that's been since about 2002 when we got into the space. So, it's seeing is believing. It's believing what the asset class that you're in. And for us, that's multifamily through and through.
Awesome. I want to talk about two product lines and offerings that you guys are in. And one is what's called the Delaware Statutory Trust, which is a like-kind replacement option for someone doing a 1031 exchange. And the other are opportunity zones. And we're going to stick in those two areas. So tell me, how long have you guys been been providing opportunities in the Delaware Statutory Trust space, and a little about 1031 exchange options for investors?
So we have been in the Delaware Statutory Trust space since 2019. We just completed our fifth raise for a DST, and 1031 investment vehicles, 1031 exchanges. Like you said, like kind, that's when you exchange out of a real estate property and you're looking to exchange that into another real estate property. So we're the professional sponsor that manages those Delaware statutory trusts that you're able to conduct that exchange through.
Right. And what does a person who invests in, they are now getting a percentage share of the whole, right? So hypothetically, your raise is $10 million. The investor puts in $1 million. I'm just going to use those numbers for easy numbers. That means they have a 10% equity share and they get income. They wind up with annual distribution income off of that, correct? And how's that calculated and how do they get it?
Correct. So we like to call that
Mailbox money.
Thank you. Yes. So based on how much they've invested, where, for example, $1 million, they would receive their pro rata share of that distribution, which is typically annualized. They're going to receive it on or before the 15th of each month based on the cash flow or the projected cash flow of that property. So really important, especially in multifamily, we underwrite to a 3% rental growth rate, but we could see something higher than that at the property level based on how we're managing the operations.
And where do you guys invest? I mean, we're both in California. Not always a great place for a big multifamily like that, but is there an area of the country that you guys specialize in?
We are headquartered in Chicago. So as you could expect, a lot of our apartments are located in the Midwest, right there in our backyard. So we love the Midwest. A lot of supply and demand working in our favor, like a property we just completed the raise on. We saw no other properties in permitted or being constructed within 3 miles of that property while it was 96% occupied. So
Wow.
we see incredible demand and a lack of supply, which is really what an investor is going to be paying attention to. We also, outside of the Midwest, really like Florida. So Florida is another big component of Trilogy. In fact, 2 of our 3 qualified opportunity fund properties, which we'll get into here, I'm sure, are located in Florida. And we love Florida because of the high barriers to entry, given all the waterways and just surrounded by the ocean there.
So I'm going to just sort of, make a joke on there as you say high barrier of entry with water. So any concern ever in that market with the barrier of water that comes from the sky occasionally in the form of a hurricane?
Right. No, especially, I mean, every year we're seeing hurricanes hit Florida, right? Like it's to be expected at this point. So what I really like about Florida and the fact that we're doing new development there is that during construction, you're able to mitigate those flood risks and hurricane risks by incorporating those really stringent Florida building codes into the construction itself. So we're already seeing the mandated regulations for the impact resistant windows and the reinforced roofing systems, elevated structures to mitigate flood risk. We're able to incorporate that into the building itself during development, which will, essentially reduce those overall insurance claims and stabilize the premiums.
Awesome. So when you guys are buying a multifamily property, you're not buying 6, 8, 10 unit buildings, you're buying large multifamily apartment complexes. What's your average number of units or is there one?
Yeah, I mean, they range from maybe 250 on up to high 3s. So,
Wow.
a couple hundred tenants is really our sweet spot there. So we like a really diversified tenant mix. That way, if, a handful of tenants are moving out, you're not going to be hit with that on the monthly cash flow.
So you may or may not know the answer to this question, but what is the tenant makeup? Is it empty nesters? Is it millennials? I know you guys have a really great project in Milwaukee.
Mhm.
Who's your tenant?
Yeah, that's a good question. What we're seeing here, especially with the large spread between mortgage, the cost of a mortgage and the cost of a rent, we're seeing a lot of not only renters by necessity, people that are priced out of saving for that down payment or unable to afford that monthly mortgage, and renters by choice. Like you mentioned, a lot of millennials. People are driven to all the highly amenitized elements that we can have in our properties, like dog parks and cabanas and movie theaters. I've seen a rooftop movie theater in one, in fact. There's co-working space for the work from home people. Simply having a fitness center isn't really getting it done. So now you're seeing a lot of highly amenitized in order to compete with those benefits of having your own home, and to also just show that you don't have to have your own home in order to have that privacy or those luxuries or those conveniences. You can get them within a multifamily apartment as well.
Wow.
So a diversified tenant mix to answer your question. It's all across the board.
So if I live there, I'm a big swimmer. So is there a pool? Is there, in a lot of these different types of properties, there are great amenities, pools, lap pool, you've got dog walk. I don't have a dog, but everybody tells me I got to get a pet, but my life is crazy enough, right?
Yeah, with all your travel, I would advise a cat, maybe instead of a dog.
What about a health spa? Are they 24-hour availability? So when someone moves into these complexes, they're really, I mean, it's an extension, right? Everything they need is right there, correct?
Correct. Yeah, it's really like a live, work, play setup is what we're seeing. So in our Milwaukee property that you mentioned, it does have a lap pool, but seeing as how it's Milwaukee, you might want to wait until Memorial Day to get those laps in. We do have heated underground parking there, so that might be somewhere you want to take some walks through during those colder months. But we did make sure to locate this property near a really large up and coming entertainment center called Ballpark Commons, and right next to this 130-mile bike path that goes all the way to downtown Milwaukee. So You're really trying to check all those boxes for tenants. You're trying to give them enough located within the property itself, but then just right outside those doors, so they can go and they can watch a game, watch those Milwaukee Milkmen minor league team play. They can go to the Lux Golf. They can have a hot dog, and they can walk back home and get a good night's rest at their beautiful apartment.
And is that kind of the focus of most of your properties? Are you centering around that kind of easy life entertainment space, whether it's Florida or Milwaukee? Got that a factor in your
we
acquisition?
definitely. Yes, we want to find primarily properties that are in the path of growth. We're mostly focused on that population growth, the market supply and demand. I think that would be the first indicator of what we would put in our pipeline. And then as you go further through the mix, there are all those boxes you want to check. But yes, having demand drivers, right? Reasons why people would want to live there.
Right.
Absolutely. Somewhere we would want to live. If I would want to live there myself, which at times with 2 middle school daughters, I absolutely do dream about moving to a Milwaukee apartment. And
for a couple of days by yourself.
Yeah. I saw some 1-bedrooms, made sure to put my name on them for the future. So, as they get older.
So let me talk from an investor standpoint. If I were an investor, and I'm curious because there are many Delaware Statutory Trust options. My company has probably one of the largest selection of options in the country. And if I were driving through Milwaukee or driving through Florida, would I be able to visit the location, or would I have to set something up with your team? Can I do a walkthrough and see my investment?
Yeah, we absolutely can arrange a walkthrough with the property management there. I know we had the pleasure of having one of your investors that happened to be in Milwaukee during the holiday season, just drive through and seemed very impressed with the property. So I think that's the best way, in fact. Why, it's there, it's not going anywhere. If you're able to get there and kick the tires and just make sure that those glossy real estate images really hold up in real life, so you're not going to be catfished at the end of the day. That's absolutely a key point of due diligence.
Cool. I want to shift to opportunity zones.
Yes.
What is an opportunity zone? I know that they first came out in the 2017 Tax Cuts and Jobs Act, and there's some changes that may be afoot going down the road, but what's an opportunity zone?
Great. So simply put, opportunity zones, like you mentioned, created under that Tax Cuts and Jobs Act in 2017 under the first Trump administration. And they are federally recognized areas where new investments from investors that might be watching here can be eligible for preferential capital gains tax treatment, with the goal of stimulating job creation and economic growth in those communities.
So what qualifies as an opportunity zone? Is it neighborhood specific, city specific? What are the drivers? Yeah.
So this was based on the 2010 census data is what determined where these opportunity zones were going to be located. And since inception, we've seen 3,800 communities have received investments of opportunity zones, with a total of 48 billion equity investments from investors and corporations. So it's no small bucket at this point.
Right. Right. So we use the term qualified opportunity zone, and then there's a qualified opportunity fund. What's the difference? Are they the same?
They are not the same. So the fund is the investment vehicle itself, and that's organized as a corporation or partnership, and it has its sole purpose of investing within a qualified opportunity zone asset. And it has to have at least 90% of that investment held in that qualified opportunity zone property.
Aha. Okay.
So we've got the zone, and then we move smaller down is the fund itself.
Aha. So there's two steps here.
Yeah.
So there's a lot of tax benefits, and I think that's what people really look at. They're like, why would I do this? Right.
Right. Yeah. So qualified opportunity zones are great. They're ideal for investors with really large capital gains that want to defer those taxes and receive tax-free appreciation. So by investing their capital gains from the sale of any asset, any recognized gain, into a qualified opportunity fund, you can defer your tax on that capital gain through the tax year 2026. And then that would be payable in 2027. So this allows investors the opportunity to put more of that capital to work now with what's essentially an interest-free loan from the government, which we know how often those occur. And additionally, if that investment in the QOF is held for at least 10 years, that's a really important fact. It is illiquid. You want to look at it. This is long-term hold, 10 years. If it's held for at least 10 years, then any appreciation in value from that qualified opportunity fund is completely tax-free when sold. So it bears repeating that investors pay no taxes on any capital gains produced through their investment in that QOF.
So you've said two really big things here. And one of them is 2026, right? So can you repeat that? So my audience is clear on this. And then you've also talked about they have to hold it for 10 years, right? They can't get out. If you want the whole benefit, let's walk through that again.
Sounds good. You're right. It is such a critical point. It's basically the whole premise of why you would want to do one of these QOFs in addition to that economic stimulation. So an investor that's triggered a capital gain from selling an asset and then invest that gain into a qualified opportunity fund can receive temporary tax deferral. And that temporary part comes in to the end of 2026. It's set to expire December 31st, 2026. So you're deferring those capital gains through 2026 tax year, which is then payable in 2027. And then in addition to that, as long as it's held for 10 years, that qualified opportunity fund, the investor can also receive a permanent exclusion from capital gains tax on that OZ investment once it's held for those 10 years.
So these are such great points. So when someone does a 1031 exchange, they get to avoid the capital gains tax bill that they get by swapping and trading into another property. Here in a qualified opportunity zone, I take $500,000 and I invest in the qualified opportunity zone as an accredited investor. And 10 years later, that's worth $1 million. Just I've doubled my money, let's say, right? For example, I pay no taxes on that $500,000 gain. Is that what you're saying? That's mine. I can go to
Correct.
Vegas.
It's held for 10 years. I mean, you do what you need to do. You got the dog at home. I hope there's a pool at wherever you're staying. But yes, you are correct.
So the expiration date currently is 2026. But how does an investor actually participate?
Great question. So it's actually pretty simple when you look at it, even though it's this big federal community economic development, it's pretty simple to get it done, right? That's my favorite. I choose simple over complicated. So there are a few simple steps. So first things first, like we talked about, the investor actually has to sell an asset that triggers a capital gain. Otherwise, you're not going to be investing in a qualified opportunity fund. Next,
so hold on a second. Does that mean, so let's say I had 2,000 shares of Apple stock that I bought in 1982. And now that's worth a lot more money. So am I talking about like selling a portion of that stock and that huge possible capital gains tax bill that I may get from that? Is that what we're talking about in terms of what we're postponing or avoiding for a period of time? Is that
That's a perfect example. Yes, that's a perfect example. Anything that is sold for more than its purchase price is a realized gain and therefore triggers a tax event that can be eligible for a QOF. So anything like stocks and equities, I've seen employee stock purchase plans as an example, any kind of real estate, residential, commercial, even blown 1031 exchanges. A qualified opportunity zone is a great backup. If you blow your exchange through the timeline or by taking possession of the funds, you can still utilize a qualified opportunity fund. And bonds, fixed income, private business and equity ownership, alternative investments, which we know really well. You can do cryptocurrency, NFTs, commodities, any kind of collectibles like art, wine, cars, coins, and even derivatives. So you can actually utilize anything from the foreign exchange trades.
The question that went through my head was Apple around in 1982? I don't know. So does a qualified?
I'm sure it was, but maybe it was orange or something.
It was a really small apple, right?
Yeah.
It wasn't the big apple that we're dealing with today.
Right.
So how does the opportunities fund investing work? How's it done?
Right. Great question. Really simple few steps there. So first, the investor would need to sell that Apple stock, right? They would need to sell their asset and trigger that capital gain. That's the first step. Pretty obvious one there. Step two, the investor would place those gains into a qualified opportunity fund within 180 days of sale. So that's an important number to keep in mind. It's 180 days of sale in order to utilize a QOF. And then at that point, that capital gain tax is deferred. Like we said, it's currently deferred until 12/31 of 2026. There is an extenders bill, which could delay that by 2 years or postpone that by 2 years, fingers crossed. But we'll go with 12/31/26 because that's the current legislation.
Yeah.
The next step is the QOF invest in the properties or assets within that opportunity zone. So we're moving the money towards that qualified opportunity zone, and the fund has to either make substantial improvements to an existing property or complete construction on a new property. So that's obviously what the intention of these QOFs is. It's to drive and stimulate what's going on in the QOZ. And then the next step, those taxes, like we mentioned, are deferred until the sooner of 12/31/26 or upon the sale of a property. I don't know of any properties, to my knowledge, that are going to sell prior to that. So I think most people are looking at that expiration date of 2026. And at which point the investor is then expected to pay the capital gains tax on the original gain in 2027. And then the last step that we mentioned, if the QOF property is held for 10 years or sold after those 10 years, tax on any gains are eliminated. And as far as I know from the QOFs that I've been with, that 10-year start time isn't going to begin or be triggered until the last investor is in the offering, to ensure that all investors comply and that everyone is capable of eliminating those capital gains from the QOF.
So there's always an amount that the qualified opportunity fund is, right? So if it's 10 million or 50 million or 100 million, what we're saying is that Trilogy, who's managing this fund, basically has to get all the money in to their satisfaction, and then that's the date that triggers the 10-year start. Is that correct?
Correct. Yes. So that's then going to ensure that every investor is going to meet that minimum of a 10-year hold prior to sale.
And I think the other point that I want to get back to is they have 180 days. So 6 months. If I sold my stock today and had that big gain, I've got 180 days to place that so that I'm protected from that giant capital gains tax bill that may be facing down the road. Correct.
Yes. Yeah. I think that's approximately 6 months.
Yep.
So you're getting a little time. Yeah. So yeah. a little time to, let the dust settle, figure out if you're going to go to Vegas, if you're going to buy your own real estate, or if you're going to invest in one of these qualified opportunity funds.
Right. So I want to get back to what you guys do best, right? You guys stay in the multifamily space. I think we've beaten up the opportunity fund and information there. I think if people want to talk to us further, they can email, call, check out. There are lots of ways, right? But I want to talk about like trends you see in 2025, right? The outlook. And one of the things that I think everybody's concerned about is insurance, right? What factors do you guys see that playing in multifamily today? And insurance costs more than anything.
Insurance costs can absolutely adversely affect the net operating income of a property. Absolutely. So those we keep constant eye on, constant track of, ensuring that we have the best cost when it comes to insurance. Again, able to mitigate that through our new development. And but yes, those rising insurance costs, I've been getting quite a few questions on them.
Yeah. Whether you're doing a single family home or whether you're doing an apartment building, these insurance costs are really out of control here. But you guys are in some good markets, Wisconsin, being in Florida, you probably have a good handle on that. So,
absolutely.
All right. Yeah. So with every guest, I always ask a question that they're not prepared for.
Okay.
So there may be a couple of questions, but
okay,
at least one or two. So when you grew up, were you a video game person?
Yes.
Really?
Yes.
Oh my
I
God.
spent a
What's
lot.
Your favorite video game?
Oh my God, Super Mario Kart. I swear, even driving as an adult, I feel like I'm, avoiding shells a lot of the times. So yeah, logged a lot of hours playing Super Mario Kart, Super Mario Brothers. I like the first, I like the third. I think my husband fell in love with me when we were in college, and I picked up a controller at San Diego State where we were visiting some friends and started just wailing on it and just trying to show what I was capable of. So that's my little
Kicked
ace
his
up my
butt,
sleeve.
right?
We're pretty competitive with each other. We actually met at a swim meet. So
Awesome.
competing is in our blood. It's in our bones.
That's awesome. That's awesome.
Yeah.
Well, Erica, hey, it's been a pleasure to have you on the show today. I hope
Pleasure's
that
all
guests,
mine, Herb. Thank you so much.
I hope that guests have gotten something out of that, right? Of the show and what we talked about. And so
Absolutely.
this is a wrap. So don't forget to like, subscribe, and stay tuned for more real, raw financial talk in the Sandbox. Thanks for coming on, Erica. Have a great day.